Hey friends, Alex here. I need to confess something that cost me years of stress and about $5,000 in potential tax savings. You know that feeling when you try to open an IRA, you finally decide to do the right thing, you log into the brokerage account, and then you see it. Two confusing options, Roth IRA versus traditional IRA. Immediately, your brain starts doing mental gymnastics about tax brackets, future income, and withdrawal rules. You realize you have to guess whether your tax rate will be higher now or 20 years from now. It's paralyzing. It's the kind of decision that makes smart people like us just click out of the tab and say, I'll deal with this later. I remember feeling that way too. But here's the problem. When I finally forced myself to choose, I actually made the wrong choice early on. My mistake taught me that this choice isn't about complicated tax codes or predicting the stock market. It's about a simple, fundamental strategy that most financial guides complicate just to sound smart. Today, I'm going to share that specific mistake with you and then give you my simple 5-minute guide to choosing the best IRA for your family without needing an accountant. We are cutting through all the confusing jargon. We are going straight to the core strategic question. This choice is the single most important decision for your tax-free wealth after your 401k. Let's make sure you get it right now. So let's go back about 5 years to when I first decided to open a personal retirement account. I had already maxed out my 401k match, so I knew the next logical step was an IRA. I felt good, like I was finally getting ahead. I went straight for the traditional IRA, and if you're a high earner right now, your brain is probably telling you to do the exact same thing. The logic seemed clear to me. I was in my peak earning years as an engineer. I was paying high taxes now. The traditional IRA offered me a sweet tax deduction today. That immediate tax break felt like an instant win. I contributed the maximum for a few years, happily claiming those immediate deductions on my tax returns. It honestly felt like free money from the government. But here's where I completely failed to see the forest for the trees. I failed to follow a fundamental rule of long-term investing. Always look at the big picture, not just the immediate win. The goal of our system is to build tax-free family wealth, not just tax deductions today. When you contribute to a traditional IRA, the money grows tax-deferred. But when you pull it out in retirement, every single dollar is taxed as ordinary income. I realized later that because I plan to be a disciplined saver and a smart index fund investor, my account balance in retirement would be massive, and my tax rate in retirement would likely be higher than my effective tax rate today. My short-term win, that immediate deduction, was going to lead to a massive long-term tax bill. That deduction I took today was essentially a loan I was taking from the government, and I was going to pay them back with massive interest decades from now. When I ran the numbers, the missed opportunity for tax-free growth was staggering. That was my $5,000 mistake. It wasn't the deduction itself, it was choosing the wrong time to take the tax break, which ultimately meant less tax-free wealth for my family. And that brought me to the core question. How do you know when to pay the tax? Now or later? This is the choice between the Roth and the traditional, and knowing how to make that call is what this guide is all about. Forget all the confusing jargon. Forget the technical tax forms. The difference between a Roth IRA and a traditional IRA boils down to one simple strategic question. When do you pay the tax? Think of your investment journey as a timeline with 3 points: contribution, growth, and withdrawal. Both accounts are fantastic, but they hit the tax at different points. Let's break down the two choices simply. First, the Roth IRA, pay tax now. With a Roth IRA, you pay the tax on your money before you contribute it. You use money that you've already paid income tax on. This means you don't get a tax break today. And for high earners, that can feel like a setback. But here is the phenomenal trade-off. The money grows tax-free, and when you withdraw it in retirement, including all the compounded growth, it is 100% tax-free. This is why the Roth is the ultimate vehicle for long-term tax-free wealth. You guarantee you pay the tax at your current rate. For young or busy investors who expect their income and their tax bracket to be higher in the future, the Roth is generally the superior choice. You take the tax hit today, and your future self thanks you profoundly decades from now. Now, let's look at the traditional IRA, pay tax later. The traditional IRA is the opposite. You contribute money before paying tax on it. This is why you get that immediate tax deduction today, which feels like a great immediate win. But the catch is huge. When you withdraw it in retirement, it is all taxed as ordinary income. Think of your retirement withdrawals like a sudden paycheck. Every single dollar, including those huge gains from your index funds, is fully taxed. The traditional only makes sense if you are absolutely certain that you will be in a lower tax bracket in retirement than you are today. For most disciplined savers in their peak earning years, who build massive, growing portfolios, this is a risky bet to make. You are deferring a small tax obligation today that might become a giant one tomorrow. So the choice isn't technical, it's a strategic calculation about your life path. It's about when you want to take the tax hit. The goal is simple: maximize the money that gets to compound tax-free for your family. Since you're probably not a tax accountant, we need a simple, stress-free way to make this decision. We are going to build a clear 3-question decision tree. Follow this tree, and you'll know the best choice for you in under 5 minutes. This is how we move from confusion to conviction. Question 1. Do you qualify for a Roth IRA? This is a mandatory checkpoint. The government limits who can contribute to a Roth based on income. It's important to check the current IRS income thresholds for your filing status. If your income is currently above the limits, the choice is simple: traditional IRA or exploring the backdoor Roth, but that's an advanced strategy. But if you are below the income limits, which is where most middle-class families comfortably land, you proceed to question 2. Don't worry, the income thresholds are designed for most of us. Question 2. Is the tax break more valuable now or later? This is the core of the problem, and this is where I made my $5,000 mistake. I was too focused on the immediate deduction. We need to think about your career trajectory and your retirement tax exposure. Scenario A, your salary is still climbing. If you are in your 30s, or you believe your salary will grow significantly, and therefore your tax bracket will rise over the next 10 to 15 years, choose Roth IRA. Pay the tax now while your bracket is lower and enjoy tax-free growth forever. Scenario B, you need immediate tax relief. If you are nearing retirement, or if you know you are currently in a very high tax bracket today and you plan to retire early, or believe you will actually be in a significantly lower tax bracket in retirement, choose traditional IRA for the immediate deduction. The Alex Bennett rule. Unless you have a specific, expert reason to believe your retirement tax rate will be dramatically lower, the Roth IRA is generally the superior vehicle for tax-free wealth building. It removes a massive variable from your future. Think of it this way: when you invest $100,000 in a traditional IRA and it grows to $500,000, the government taxes that full $500,000. With a Roth, they only tax the initial $100,000 today. The growth is all yours tax-free. Question 3. Do you need access to your contributions before retirement? This is a lesser known but critical difference for busy families. Retirement accounts have strict withdrawal rules, but the Roth IRA offers a massive flexibility advantage. With a Roth IRA, you can withdraw your contributions, not the earnings, at any time for any reason, tax-free and penalty-free. This is huge if you are a young family saving for a first house, or if you simply want a financial safety net for unexpected expenses. You know that money is there if you desperately need it, but you're still investing for the future. With a traditional IRA, withdrawing money early usually triggers both income taxes and a painful 10% penalty. The flexibility is gone. If financial flexibility and access to your capital in an emergency are important to your family today, the Roth IRA offers a clear advantage. Follow these 3 questions. Don't overthink it. For most busy families seeking long-term, tax-free family wealth and peace of mind, the Roth is the clear winner because of its tax-free withdrawals and superior flexibility. It's the smart, simple choice I wish I had made 5 years ago. Now that you know which IRA is right for you, the next step is to choose the right partner to open it. Now that you know which IRA is best for your family, the biggest barrier to getting started isn't deciding between Roth and traditional. It's choosing the platform and actually pressing the button. The immediate decisions are often the hardest. Imagine having that IRA account set up. You've made the smartest tax decision for your family's future, and now you have a new engine, running on autopilot, compounding money for decades, completely tax-free. That feeling of confidence, of being totally on track, that is the real reward. So you've mastered the what and the why. Now let's talk about the where. Choosing the right brokerage, one with low fees, low stress, and great service, is crucial to making your IRA machine run smoothly. If this guide clarified the Roth versus traditional debate for you today and saved you that tax headache, do me a favor and hit that like button. It truly helps me know that these simple, honest guides are what busy families need. And I have a question for you. What is the biggest tax question you still have about retirement? Let me know in the comments below. I read every single one, and your question might become the focus of a future video. If you're ready to find the absolute best platform to open your new IRA, make sure you subscribe. We're doing a deep dive comparison of the biggest names in the industry next week. Finally, if you know someone else who's been putting off their IRA decision because of this Roth versus traditional confusion, please share this video with them. You might save them a huge tax headache down the line. Right here is the video where I compare the two platforms most trusted by disciplined family investors, the platforms I use myself. Don't start trading until you've watched it. Thank you for being here. Now go and claim your tax-free wealth.